This is our Forex blog for March 29th, 2013, and we released a new version today, just a few minutes ago actually, version 4.319. So when you bring up the software, it'll tell you that there's a new version. Would you like to upgrade? Just click yes, and then you'll be able to download it. Basically, it has two changes. One, the weekly value areas that I put in earlier in this week. I didn't test enough, and it wasn't updating it live, and that now works. And also, I've added the Bollinger Bands to the currency indexes, and you can, if you don't want to see those, simply put 0 for the period at the beginning, and then they won't show up. As you can see, gone. And of course you can change those to any color you want. The first period is the number of periods, and then 2 standard deviations, and then the third one is how thick the lines are. So if you want them bigger than 1 pixel, change that from 1 to 2 or 3. And you can also change the color of the bands. I like to see them, but not have them stand out. Okay, so now that you know what's new, let's go over how to use these. For the last 6-7 years, we've been working on statistical comparison tools, currency meters, to help you identify which currency is strong, which one's weak. And now we also have currency indexes, which is basically a chart of every dollar pair, every yen pair, every pound pair, every euro pair. And you can very quickly look at it to see what the trend is. Is it going up or down? You can also see double tops, double bottoms. You can draw fibs on it. You can draw trend lines on it. Wedge patterns, flag patterns, continuation patterns, reversal patterns, all work. And of course, you also have the point of control, which is a volume profile technology. This shows you where traders had the most positions in all dollar pairs yesterday, and if it went down, like you can see from the previous day, it tells you that. So it fell 11 pips, the euro fell 7 pips, the pound index went up yesterday, so you can see it's above its point of control. So if you see it come down today with a little bit of weakness and then double bottom at that level, bottom go right to the Bollinger Band, you can kind of, as you can see, almost perfectly time a buy, because yesterday it was an up day, so it's likely to have some continuation today. And you can also see the point of control of the previous week. It was up 114 pips. So a lot of information on the charts, and if you don't see the weekly point of control, you can always change the time frame from 5-minute to hourly, and then you'll see it, or you can zoom out and then in this case, let's just change that to 60-minute. And when this comes in, you should be able to see where the point of control is and if price is above or below it. So you can see in the yen, it's actually above last week's point of control. And last week, the yen went up 73 pips from the previous week. So we'll switch back to a 5-minute chart very quickly. And when you trade every day, you already know these things. The weekly ones don't change, only about once a week. And you can have the currency indexes for any intraday time frame. You can have daily ones, you can have weekly ones. If you go period D, you can see what the yen index looks like on a daily basis. So you can see it's been falling, made a rally up, came back down, double bottom, is just kind of hovering down there. No clear direction of whether it's going to continue the down leg, or it does look like it's gone sideways long enough that if it does break over this level, we should have 1 day to maybe a week or 2 or even longer of reversal. Alright, so that being said, how do you use these tools? Well, it's simple. Like I said, you want to find currencies that are trending up to buy. And here's some of the patterns that I'd look for. The daily and weekly trend is up. This one is hovering, trended up earlier in the day and it pulled back. A lot of times when they go below the lower Bollinger Band on there and they peak back above it, it's a pretty decent place to get in. As you can see here, here, and here. Almost perfect timing. And when a currency fails to make higher highs, you can see a high, a higher high, slightly higher high, and at that point it's not, it's not able to bust through the high anymore. It's pretty safe to assume that the uptrend's over, and as soon as it breaks down through the support level, you're now looking for shorts. So sell it right there. It really probably didn't generate too much profit there and there, and this is usually the dead time of the day, especially on a Friday, especially on a holiday. You may not take that trade, but earlier in the day, pretty decent high probability buy, a little bit around 130 at 3, 330, and 4. And you want to buy the yen versus whatever the weakest one is. Now the yen's always on the bottom, so you'll actually be selling the weak pair versus the yen. So at 1 o'clock, you can see the euro broke down from above the hourly to beneath it. It's kind of going sideways right there. So certainly looks like it's going down. The weekly monthly trend, blood red. So you're certainly, you know, at 130, looking at the euro yen for a sell makes sense. Let's bring that chart up. Take a look. Now I mostly use range charts for trading, but I'm going to be using 5-minute charts just because it's simpler for you know, illustrative purposes on here. So at 1 o'clock, you can see this was above the hourly. It's been in a very tight wedge pattern, broke down at 1. So you had not that big of a move down, maybe 8 or 9 pips. You would have initially put your stop here and, you know, drove your stop down. And then it came back up to the hourly, couldn't get above it. You go short again here with your stop, and that trade worked. And notice our perfect oscillator. When it gets down to the extreme, minus 80, it's telling you that it's gone down statistically too far. So you're going to get out of your trade somewhere in this level down here. But you can see you made a considerable, let's say you got out halfway in the middle there. You made, that's what your risk is, that's how much you made. You made probably 4.5 to 5 times more than what your risk is. And so with those kind of win-to-loss ratios, you don't even have to be right 30% of the time to still make money. So let's go back and take a look again. A little bit before 3. Is this one weak? Well, it's at the upper band. It could and is oftentimes likely to stall there. And if one currency is going up and another one's going sideways, you'll still make money selling the euro yen. Ideally, you want the euro to be falling and the yen to be going up at the same time. And then instead of making, you know, 8 to 15 or 20 pips, you're going to probably make 20 to 50 pips. So let's go back and look at this at 3 o'clock. Notice a little pullback right here. A lot of times when the perfect oscillator goes through the Bollinger Band and then comes back out the other way, it's usually a pretty safe place to get short, somewhere around 120.52, and you can see it pulled back to 33. So pulled back 20 pips. So where you get out in that range, you know, it's debatable. Let's bring up a range chart, and this will give you a clearer perspective of where to get out. And you can also use tick charts as well for timing of entries and exits. So say you were looking at that pullback, and let's say you got short here at 120.50, pulls back, you have 1 bar up. Typically, worst case scenario is I'm going to get out of that trade right there as it comes back above that level. This is also the value area low of yesterday, and it's likely to be support. And so if this level is penetrated and stays underneath there, it's very likely to go down and test the lows here. If it doesn't and can't break these lows, you know, it's likely to act as support, which it did here, here, and again here, unfortunately. So not every trade is going to be a home run. You're going to have some 5 to 15 pip wins. But keep in mind, if you get just 10 pips per day, every day, you will, in the course of 2 months, double your account. There's a $2,000 account. You're just getting 10 pips per day. $2,000 account at the end of 2 months, 8 weeks, $38.97. 2 more weeks, it's now 8,000. 2 more months, I mean, it's doubled again. Obviously, you can see the power of compounding. At the end of 1 year, 258,000 from 2,000. So 10 pips per day is a good lowest goal to have. And that uses about 2% risk per trade. So even if you're wrong 4 times in a row, you've only lost 8% of your account, which one really nice 30 to 50 pip trade can get back. All right, so we're going to look at one more example here. The pound, as you can see, was an up day yesterday, even without even scrolling back. Last week was a very big up week. The point of control went up 114 pips from the previous week. Now, when I say pips, this is a pound index that I created. It doesn't exist anywhere in the world, so I'm just calling these things pips to keep it simple. A 10 pip move from 95.40 to 50 is a relatively decent size move intraday. 20 pip move or 95.40 to 95.60. I'm just going to call those pips, even though, again, they're not pips. This doesn't exist anywhere else. But to keep it simple, since I created it, I'll call it whatever I want. I want to call it pips, keep everything synonymous. But that being said, a 10 to 20 pip move is a decent intraday swing. You can see this euro move from the low to the high is about a 15 to 20 pip move. So for the whole week, to the average price having gone up 114 pips, very significant. So that being said, last week was an up week, yesterday was an up day. It pulls down today with decent weakness. So you could be looking to sell right here, but when it comes down to the low, can't break it, the weakness is gone. Pretty safe place to buy because the pound was up last week and a lot, and up yesterday a decent amount too. So you look for buys at 3 o'clock. Which one is likely to go down at 3? Well, the yen right here, double tops, fails to go over. It's also at 3 o'clock above its upper Bollinger Band. Most of the time the bands, when the price hits it, they either stall or they go up a little bit more, then they reverse. They hit the lower band, they go up, hit the upper band, down, lower band, up. You can see how many times these bands reverse. I mean, here, obviously, here's a failure. So that one didn't work, but almost every other time, as you can see, the bands cause price, and not always. I mean, there's a failure. It did reverse, but an hour later. Do you see, though, how often price reverses off the bands? So if you want, and that's the reason I put the bands in, and this is a new release today, but the yen's, likely to reverse. It also has another reason to reverse. It didn't go up the first time with incredible momentum, it's just with average momentum. And then the second time it had slightly less momentum. So you have clear divergence at the high. It's it's likely to reverse. So 3 o'clock we're going to be looking for pound yen buy. And this will be the last example for today, but this is how you can anticipate future price direction. It's one thing to show software and how it did in the past, but these are methods that you can anticipate future price direction over and over and over again. So here's, actually let's go back here to make sure we have the exact times. This is at the low here at 315. This is at the high here at 305. So somewhere between 305 and 315 we're looking for a pound yen buy. Okay? Zoom in on this, and here's 305. Here's 315. And this is another perfect example of why we'd want to use a range chart, because unlike a 5-minute bar, which could be 30 pips in distance, a range chart is however many pips you set it to, and this one's a 5 pips per bar chart. So you can, on a range chart, see that pullback. This is somewhere around 310, 315 right here. It's at the point of control of the previous day. Unfortunately, the point of control of the pound yen itself is down 10 pips, but it's not that much. So when it goes back from underneath that to above it, pretty decent place to go long. You put your stop here, and whether you got out of half your trade here and only made 10 or 12 pips, or got out of half of it and kind of scaled the rest up, it's up to you. You might have got out of half for 10 pips and made 24 pips on the other half, for instance, when it came up to the hourly and failed. But again, another very predictable move. And I'd like to end class today with showing a tick chart. Tick chart might even be better than a range chart for finding exact entries in anticipatory trades like this. So we'll start with a 20 ticks per bar range chart. I'm going to put this on layer 12 because that's the one that I have visible. And this is all based on price changes. We're going to go and look at this at, what was the time again? 3:05 to 3:15. Alright. So unfortunately, this was a pretty big bounce back on there. And this might actually be better to look at a 3 pips per bar range chart than a tick chart when price is that frenetic. Here you go. So these are 3 pips per bar. This one, and sometimes price gap, so that's why this bar here is bigger than all the rest of them. The rest of them are, most of them are 3 pips per bar. You would actually get into this trade right here at 70. You would have about an 8 pip stop on this. Oops. And you can see it kind of went your way a little bit, 10 pips. And when they're kind of going up and down like this, I'll tend to get out of half my trade, and then I'll move my stop up underneath the lows here. And I might have got out of that trade somewhere in here because it really doesn't look that good. And basically what you have to do then is just kind of, when it goes over the high here, get in it again and just be very quick to get out as soon as it kind of stalls. I would probably accept 7 to 12 pips. The whole number and half numbers tend to be major resistance, so when it goes up to that level and can't get above it, you want to get out. And you also want to always draw your fibs on the first wave. Usually the 1.618 is your maximum profit. So if I was in this and out with a quick 8 to 14 pips on the first half, buy it again here. I'm going to probably exit half my trade here and the other half here. My average price on the second one would be 97. I would have been in this at 86 for 11 pips minus the spread. It's not bad for the second entry. So that's how you use the tools. And looking at this chart here, you can clearly see that that trade maybe is not likely to continue because it's really close to the 80 level. The perfect oscillator, I call it perfect because when these levels get hit, usually you get reversals. Notice reversal, and it went up. The second one went up, nailed the high here, went down 30 pips. The second one here, down, down. It's telling you basically the market's moved too far, too fast for that time of the day. And it uses statistics, it doesn't use periods, and it works on all time frames. So it's one of the best tools in the software between the currency indexes, value areas, range charting, and perfect oscillator. I don't think you can go wrong if you practice this a month or two, understand the statistics, what your win-loss ratio is, and the amount of pips you make on your average win versus a loss. I think you'll feel confident that you can trade for a living if that's your goal.